Hi, in this video I'm going to explain the revenue recognition principle. First off, we should start by understanding what revenue is. Revenue is the increase in resources resulting from the sale of a good or provision of services, and is recorded on the income statement. An example of this would be receiving cash as a result from selling a phone. Although revenue relates to the increase in resources, there may be some instances where that increase does not occur at the exact same time the sale takes place. This is where the revenue recognition principle comes in to assist us to correctly categorize and account for our revenue. This principle states that revenue should be recorded when a resource has been earned, regardless of if cash has been received. Assuming the accounting period ends on the last day of each month, this means that even if you sold a phone in May but don't receive full payment until July, that sale would still be included in the May accounting period, as that is the time revenue was earned. Further to this, there are two types to be considered, the first being accrued revenue and the second being deferred revenue. Accrued revenue is when payment is received after the sale of a good or provision of a service. As an example, say two friends go to a restaurant for dinner. The friends place their orders, receive their order, and then pay before leaving the restaurant. As the goods were received prior to the payment being made, this would be classified as an accrued revenue. Another example would be if you were to hire an accountant to complete your taxes. After receiving the details, the accountant would go away and process your claim. Once the claim has been finalised, the accountant would then receive payment for their services. The service was provided before cash was received, making this an example of accrued revenue. The opposite of this is deferred revenue. This is where payment is received prior to the sale of the good or provision of the service. Say Chelsea hires Kevin to paint an artwork that will be hung in her living room. Chelsea pays Kevin prior to any work being started and simply collects the painting when Kevin is done. This is considered deferred revenue as payment was received before the revenue generating actions occurred. Another example would be if Mark was to order custom uniforms for his weekend sports team. He places an order online and makes a payment on the 20th of February. On the 15th of March, Kevin collects the uniforms from the sportswear store. This is considered deferred revenue, as although payment was received in February, the uniforms were not ready or collected until March.